Hello and welcome to Your Money, Your Core. I'm Ben Clark. If you have a question about shares, our phone lines are now open on 1300 30 34 35, or if you prefer, you can email us on yourmoney@skynews.com.au. Welcome to the program. Tonight I'm joined by Roger Montgomery from Montgomery Investments and Stephen Hogan from Novus Capital. Gentlemen, welcome to the show. I'll go across, I guess Roger, you chimed in early there anyway.
Yeah, sorry about that.
That's all right. I haven't seen you for a few weeks.
It has been a few weeks.
Yep,
It's been a great reporting season for us.
It's been good. I was going to ask you about reporting season because were there any stocks that you saw opportunities in that you've sort of dived into since I was last time?
We did, and where we did prior to the announcements of their full year results were companies like Corporate Travel Management. We've done really well there. The simple reason for buying Corporate Travel Management was that we already own Webjet, we already own Flight Centre. Their results came out first and they were absolute crackers.
Yeah, they were.
And the shares were re-rated significantly, which has obviously been beneficial to everyone in the Montgomery Fund. And then we ended up buying Corporate Travel Management because it was one that we didn't own. It met all our criteria. And we just thought, well, if private travellers and family travellers are going to be travelling more with a strong Australian dollar, then so much more for corporate travellers. And sure enough, they didn't disappoint with that result.
I did see that was a great result. Yep.
Car sales was another one
that
had an absolutely fantastic result.
Anything that disappointed in the portfolio that you're a bit upset with?
Fortunately, no, not this time around. I mean, that's not to say it won't happen in the future, but this time around it's been really good.
That's good. Now we'll go to a caller. Anthony from South Australia. Thanks for calling in. What have you got to ask?
Hi, thanks for taking my call, Ben.
No problem.
I would like to ask about Regis Resources, RRL, and particularly with Roger's intrinsic value, what he thinks it is. But also gold in general. I heard Nick Raj last night say that his portfolio is 25% gold now.
Wow.
Yes, and I was very surprised. And I know tomorrow night Les Sanchez is coming on, and he has predicted gold to go $4,000 to $5,000.
Well,
I'm thinking perhaps your show will be all gold soon, but we'll wait and see about that. But I'd appreciate it if Roger can give me his intrinsic value on Regis Resources, and also if he's looking at purchasing more gold shares.
Okay, thanks for the call, Anthony. Regis Resources is probably one of the best performing gold stocks in our market. It's been a beauty. It just never seems to pull back too far.
No,
what do you reckon?
Well, look, it's at $4.94 or thereabouts, and we have a valuation, an upper valuation of $5.54 on it. So it's it's within 10% or thereabouts of its valuation. So it's getting close to what we think it's worth. Having said that, our views on gold are generally positive. We own gold. We're comfortable with one gold stock in particular, and that's still Silverlake Resources. I'm cognizant of the fact that the Red 5 also looks good and Troy looks good, but Silverlake's our preferred pick. We don't own Regis, despite the fact that it's done very well.
Tim from Queensland, thanks for calling in. What have you got to ask?
Hi Ben, I'd like to briefly put Rogers on the spot again in regards to our Decmil Group.
David loves doing that.
I've held it now for over a year, and it's been by far my best performing stock, and I'm actually quite in it now, and I just want to know if it's still got a good run to go or if it's over its intrinsic value now.
Okay, well this is an interesting one because I know, Roger, that you sold out of mining services stocks back in April, but this was a company you still quite liked.
We sold all of them except Decmil. We sold Decmil a bit later. But having said that, we are out of these companies. Decmil has exposure to oil and gas. So unlike Forge and some of the other mining services which are either coal exposed or iron ore exposed, we like Decmil for that reason. We think that has better prospects. All of the mining services companies have a full pipeline. They look great. The results came out. They're absolutely tremendous, and everyone's jumped back into them. And Decmil, more than most, it's run up. And as David has mentioned on the phone, it's been a fantastic performer. And David owes me lunch, but the reality is that at the 2 years out, what happens then? And that's the question we've been asking at the briefings that we've been going to. Sure, the pipeline looks good for next year and even the year after, but then what? And I'm concerned, and I'm not as bullish as others on an iron ore recovery. I'm not as bullish on a a base metals or bulks recovery. And in fact, I'm quite bearish on them. I think the prices could go down significantly further. And if that happens, I'm just very concerned that you have to play, quite a nimble timing game to get in and out of these things before everyone else gets scared again. That's my concern. So we haven't bought Decmil again. We think it's the best of the bunch by far, but we're not willing to go into it because of our long-term view about the prospects for these businesses.
Yep, that's good. We'll get on to the next caller, Robert from New South Wales. What can we help you with?
Okay, hi Ben. Look, I've got a company I hold shares in, BCI Iron, and it's a pretty decent company. It's got a $270 million market cap, about 104 million shares on issue, and they've got earnings of 51 cents a share. They pay a decent dividend, and for week after week, month after month, you've got to put up with this rubbish. There's 143 trades today, the total value $45,000, and when you divvy that up, it's $320 a trade, and half the trades today, 72 out of 143 trades, were for one share, all spaced out at 5-minute intervals, and another 46 trades were under the minimum trading parcel of $500. So altogether, out of 143 trades, 118 of them were unmarketable parcels. Why is it that us people have to buy $500 worth, yet a machine can buy one share at a time and manipulate the price up and down and not pay brokerage?
Well, Robert, I think that's a frustration that many market participants are feeling, and have a feel for us. We've got to try and buy these shares on behalf of clients, and sometimes I'm telling you it can be an absolute nightmare in the more liquid stocks. Look, for whatever reason, and I think the ASX has a vested interest in high frequency trading. They earn, there's a lot of turnover these days comes from that area of the market.
It's about 30%, or up to 30%.
30%, yep.
From and HFT.
I think it's here to stay. I wish it weren't, but I think that's just the way the technology is going.
But I think, Robert, if you don't mind me saying, I think you're looking at it far too closely, and you're getting yourself annoyed. If you own the stock, go for a walk. If you're happy owning it, go for a walk. You own the business. As value investors, long-term value investors, we're not concerned at this stage by high-frequency trading. We are interested in owning businesses for a long period of time, and for us, if it gives us the opportunity to buy it cheap, well, we do. If it doesn't, well, we don't. It's as simple as that. It is the market. It is the new regime. There's an inquiry into it, and we'll see what comes out of that. I've been asked to make a submission on it, but I think you're looking at it far too closely. You don't need to worry about it. If you're happy owning the business, then just continue to own it.
Yep, I couldn't agree with that more, Roger. I think, Robert, you just got to take your eyes off the screen. Don't worry about what the computers are doing. The long term, the short term, there are opportunities in the market as the volatility occurs. But in the long term, the market works out the values of these businesses pretty accurately. And I think BC Iron, if there was one iron ore business I was going to buy, that would probably be it because of its strong balance sheet, and it's just pretty much a royalty stream from Fortescue. Anyway, we're going to go take a quick break now, but before that, we're going to do a stock watch. Roger, you were hoping to go second and fighting for it, but you're not. What are you watching?
Okay, so at the moment we're looking at a company very closely called Corporate Travel Management. We already own some shares in it. It's run away from us a little bit. We think this is a business that has very bright prospects, particularly in the United States. If they can roll out their technology and grab market share over there, as they've done in Australia, they'll do very, very well. At the moment, though, cash flow is flat and the stock appears to be a little bit expensive. But watch out for it to decline, and if it does decline, there's an opportunity.
Beautifully done. Welcome back to the program. I'm Ben Clark. If you've got a question you'd like answered tonight, please give us a call, 1300 34 30 34 35, or email us at yourmoney@skynews.com.au. Okay, the next caller is Helen from New South Wales. Thanks for calling in, Helen. What can we help you with?
Oh, hi guys, how are you?
Good, thanks.
I'm ringing about Sirius Resources.
Yes.
I first heard of it from Market News, and it's been on my watch list, and over the last month it's gone from 80 cents to today's gone to $2.24. And Bell Potter initiated a research coverage on it as well on the 30th of August. So I was wondering if, you guys can shed a bit of light on this company and if it's worth investing in or not, and if it's got a bit more legs to run.
Yeah, well, look, this has been probably one of the most successful speculative stocks we've seen in recent times. Have a look at that chart. It's just gone absolutely north at an almost vertical sort of rate. Roger, I don't know if you will have come across this one.
It owns something called the Polar Bear. Polar Bear lease. It's a nickel lease, and it's a precious metals explorer. That's about all I know. Okay. And I know it makes no money.
Yep. No,
so I can't value it.
Make no money.
Yeah. Absolutely delighted that Helen owns this. Well, did she say she owns the stock?
I think it's on a watch list.
It's on her watch list. Yeah. That's a shame.
Yeah.
You know, I mean, that's a real shame because, you know, I would dearly love to own a stock like this that moved that much that quickly. But I can't find a consistent way of valuing these things. It's a resource in the ground. They've upgraded the resource, and so the valuation has changed based on the possibility that they'll get it out. Yep. They don't know who they're going to sell it to. They don't know what price they're going to get for it, and it's just full of risk. You know, and you don't know what the costs are going to be. And look, think about all these iron ore companies at the moment and the coal companies. Their product is being priced in US dollars, which is they're really suffering because the Aussie dollar is so high, yet their costs are Australian dollar based. And so the result is that they're under pressure. They've got a commodity that they can't change the price that they're receiving on. It's just a really terrible business to be in, and it's full of hope. And you always hear these stories about someone made, you know, several $1 million buying these things. But what you don't hear is all the people that lost out.
Yeah, that's right.
And it's more like gambling than investing. So I think you really, if you're going to be an investor, you just let these go to the keeper.
I think the next caller is Charles from Victoria. Charles, what can we help you with?
Thanks very much, guys, for taking my call.
No problem.
I've been keeping an eye on Sirtex Medical, SRX. Their chart has looked fabulous this year. They're a cancer treatment delivery. They make a cancer treatment delivery system called Microspheres, which has been selling very well internationally and growing. For the last 5 years, they've had annual sales growth in the USA every year, up 32% in the past year. And to June 30, net profit after tax rose by 50% to $17 million. Return on equity 23%. Zero debt. Holding cash, $49 million in cash. Just looking at their chart, just two worries I have is the PE ratio is now about 24, and from a technical point of view, they're at $7.80. It's sort of approaching the past all-time high of $8, which could be a major sort of resistance point. Yep. Just sort of any thoughts on where this is heading, do you think?
Okay. Well, it doesn't sound like you've got too much to worry about there, Charles. It sounds like a great performance. The one thing I will say before I pass to the boys is a PE of 24 for these sort of companies, if it is earlier on into its growth phase, you know, the market can pay those sort of PEs. I mean, I know CSL at the moment is trading on 22, 23 times, and you would say that's a much more mature business in the space. Guys, Roger, have you come across this one?
Well, yeah, not only have we come across it, we own it.
Okay, glad to
we
hear
own
that.
it. We've been recently purchasing some shares in it. We visited the company. We had briefings with the company yesterday. They have a radioactive polymer sphere which emits radioactivity primarily for liver cancer, and it's very directed, and for that reason, it's very effective, or it's seen to be more effective. We think the potential for this business is absolutely enormous. As the caller just mentioned, no debt, rising profit figures. We think there's some blue sky potential in it as well. It's trading on or about its intrinsic value now. Yep. That's why we're interested in it. And so we believe that now we're not buying it, we're not selling it, but we think if that blue sky potential actually eventuates, then we think this business is going to be worth considerably more where it's trading today. We're less worried about PE ratios of 24 when it's a great quality business with little or no debt and good potential. But obviously it'll be derated if that potential isn't crystallised soon.
Yeah. That's a good summary. That's fresh off the press there for you, Charles.
If it's all right, can I just add, the idea that a price reaches a previous all-time high is irrelevant. It really is irrelevant, and And anyone who does enough research into this idea that a previous all-time high is a major resistance point, anyone who does that research will realise that 50% of the time it's true and 50% of the time it's not. It is irrelevant, because when you look at a chart and you pay no attention to what the business does, you're not taking into account the fact that management has changed, or even that the entire business model has changed. So where the price was previously is irrelevant to where it is today. What you need to do is you need to look at the future prospects of the business itself, and that call is doing that as well. So I think that's excellent.
Yep, all sounds good to me, Charles. I'll have a look at that one tomorrow. Now, next caller, Abe, a favourite on the show from New South Wales. What can we help you with?
Thanks, Ben, for taking my call.
You're welcome.
I have a large holding in Rio Tinto, and I've had them for years. And of course, as you know, they've been hammered. And I'm thinking of diversifying, or at least reducing my holding substantially. I just wondered if the panel can give me an idea if they can suggest some other shares which have been equally hammered and which have a better potential of paying dividend, either paying dividend or a better potential for improvement in the share price.
Okay, thanks a lot, Abe, for the question. I'll chip in first there with a thought. My experience in the market is that you don't want to necessarily be getting into another stock that's also been hammered. Companies' share prices generally fall for a reason, and you know, no greater than Rio. The iron ore price briefly was under $100. It's still at a very low level, and the aluminium price is still horrible, which Rio is a big producer of. So what I think you want to be trying to find, if you're thinking about moving across, is a company where if you drew the line in the sand, you'd say, I'd rather buy that company now than I would something like a Rio, regardless of what the share price performance has been, as long as I'm happy to pay the valuation that the market's currently offering. But I'll keep going. Roger, you don't hold Rio.
I was about to say exactly the same thing with respect to jumping out of a stock that's gone down a lot into another stock that's gone down a lot. What you want to do is you want to buy great businesses. Rio, let me say this, Rio's intrinsic value, our estimate of its intrinsic value now is about $44, so it's still below where it's currently trading. We think that intrinsic value might rise to 59 next year. However, let me say this, that's based on analyst forecasts who have no real idea about where the iron ore price is going to be in 12 months' time. They've demonstrated that now. And people need to remember that for the rest of their investing lives. You know, Nev Power came out from Fortescue Metals Group, you know, and he said 6 weeks ago that the long-term iron ore price would be about $120 a tonne or thereabouts. Let me tell you the technique that he used for actually working that out. He licked his finger and he put it in the air, seriously, and he went, oh, that's about right. They have no idea.
Well, I think that also might have been the price where Fortescue's making a bit of a buck off the back of it as well. So
the reality
there's a bit of hope there.
The reality is that commodity prices regularly, consistently trade below the cost of producing those commodities across every commodity in the world, whether it's corn or wheat or whether it's pork bellies or whatever the commodity is. For years and years the commodities will trade below the cost of production, and people need to realise that there's nothing special about this year, and the price could fall to $50 or $40 a tonne, and if that happens, if that actually happens, then the share prices of Rio and BHP could fall a lot further. Let's remember that between 1984 and 2004, or 1985 and 2004, the iron ore price traded between $15 and $20 a tonne. And between 2004 and 2007 it jumped to $187 a tonne, and people think that's now going to be the long-term average.
Okay.
It isn't.
I
know your view.
I get all that, and I agree with a lot of what you're saying, but I'll pick you up on something.
Sure.
Gold's a commodity. You own gold stocks.
Yes.
You know, is the gold, potentially gold could be in a similar sort of scenario?
We don't see gold as a commodity, we see it as a currency.
Right.
Okay, so what we're seeing is we're seeing a devaluation of currencies across the board, and that's why we're seeing this mad rush in Australia to our bonds, and that's why our Australian dollar is being supported. You might not know this, but ME Bank today priced 3-year fixed rate mortgages at 5.39% because they bought $200 million, or they sold $200 million worth of bonds, 3-year bonds, to a Japanese investor for about 4.9% or 4.3%. 4% or 4.5%. So the overseas investors are desperate for yield and they can only find it in Australia. Everywhere else in the world, currencies are being debased.
Yep.
We see gold as an alternative currency.
Yep.
That's why we're interested in it, not because it's a commodity.
Okay, we've got some callers online. I think the first one is Ken from Queensland. G'day, Ken. What can I help you with?
Yeah, thanks, Ben. Could the panel tell me what they think about Eax Energy Action Limited, please?
Yep, okay. This is actually one I know that Chris Kimber had a lot to do with the float on this one, and I remember he offered me stock in it, and I had a look at it and unfortunately turned it down, which I've been kicking myself ever since. Roger, any ideas on the business?
We thought the result was excellent.
Yep.
We don't own it in our fund. The reason why is simply we want to understand the business a little bit better.
Yep.
So it could be just a timing thing for us. Now, some investors would look at that and they would say, well, Roger, you've missed out on this great run. We're less concerned about what we miss out on than what we could obtain.
Yep.
And so we are looking at it closely. We thought it was an extremely good result. For those viewers who don't know what it does, it's if you like, a repackaging or auction of energy supply, electricity, look, the result was excellent.
Yeah.
I don't want to say any more than that because I'll give too much away,
yeah.
but we do like it.
Yeah.
Our estimate of intrinsic value appears to be higher than where it's trading.
And I think it's definitely going to be a growth area in the years ahead as people try and get their electricity bills down.
Well, and that's clearly where their demand is coming from.
Yeah.
By packaging it up and bulk buying, you get discounts.
Yep. Next caller, John from New South Wales. John, what can we help you with?
Oh, thanks, fellas, for taking my call. Look, we've been looking at a stock, ASG. I bought in at 80 cents. They had a terrible reporting season just recently when the stock peaked at 86 cents just prior. After the reporting season, it dropped down to 62 cents. What I'm concerned about, one of their major shareholders sold just prior to the reporting season, and they sold quite a substantial amount of stock. I'm just wondering what constitutes insider trading, and if people are aware of these things that go on, and it leaves a bit of a sour taste when you drop that amount and people get out prior. If there is sort of something that can,
Yeah, well, look, John, there's always two sides to a story. It might have just been a great decision by the manager that sold that stock. Coming into reporting season, he might have picked up on something that he thought, the company might disappoint. There might be all sorts of reasons. I'm sure this sort of thing does happen in the market, but I think there's managers buying and selling stock all the time. You see the change in substantial shareholders. There's always some you'll see get in at the worst possible time and some that get in at the best possible time. But ASG is one that I had a look at. I thought the result was pretty poor, to be honest. I think there's some value in the stock. It is trading a big discount to the IT sector. But this was one of the sectors that really blew the doors off, I thought, in reporting season. A lot of these stocks reported fabulous results. And, it would have to be pretty disappointing that this one came in well under analysts' expectations. But, Roger, did you have a look at the result or the sector in general?
We prefer businesses like DWS,
yep.
In the IT services space.
Yeah.
We haven't owned any businesses that have had that kind of downgrade when they've had that downgrade. So we don't like this particular company. It doesn't come up on our screens. Can I just make a point just about the observation that you made, Ben, that relative to other stocks in the sector it appears cheap? Because I hear that a lot, particularly amongst brokers, not so much amongst fund managers. But this idea that a stock is cheaper than the others and therefore it's going to catch up is a little bit like putting a Ferrari Formula One car on a track with a VW Combi and saying, well, look, the Ferrari's way out in front, eventually the Combi will catch up. It will never catch up. So sometimes they're cheap for a reason, and you made that comment earlier in the program tonight. And this could be an example of that. It deserves to be cheap because it's an inferior business. And look, Telstra's just spent, for example, almost $1 billion just on data centres alone. So the cloud computing is all about servers, and so you're punching up against big heavyweight guys who've got a lot of money and plenty of patience and access to more capital, and that's the difficulty I have with some of these smaller operators. That's all.
However, in the telco space, look at IiNet, TPG, they're going gangbusters, and that argue could apply to Telstra in that sector as well.
Correct.
All right, we'll keep going. I think we've got an email now, so it's our first email for the show. It's from David in Western Australia. He's written, Hi, I'd be really interested to get the views of Roger on Seek.com. It's been a favourite of his in the past and wonder whether it still is and why it has underperformed recently. Has it had a good result a few weeks back? I could probably chip in with this one as well. Seek is a stock that we own. I think I thought the result was very strong. It has just gone ex-dividends. That could be one of the reasons why it has had a bit of a pullback.
We think it is.
Yeah, and there's also been, there has been some layoffs. I guess there's the perception that locally in Australia there will be a softer employment environment. However, I think Seek still can grow its earnings locally through the migration from print to online job advertising. For us, the real attraction to the business lies in the international business. It has the #1 job websites in almost all of the big Asian countries and the #2 in China. And if any of those turn out to be the success that Seek.com has been in Australia, shareholders will be very well rewarded. But Roger, I shouldn't take it out of your mouth. So what do you think?
We're all on the show together, so it's no problem. The reality is that that their Chinese business in a buoyant IT bubble in the United States, they could float that Chinese business alone, and that would get them $1 billion. I reckon. So that's all speculative. Let's put that to one side. The movement in the price in the short run shouldn't dissuade anyone. Don't take price as your cue for whether the business is good or bad. And I think you're right. I think there's two reasons why the share price has slid recently. One is it went ex-dividend. On top of that, there's been some reports of a softer employment environment. If that's true, and there is expectations, for example, in the market that there's going to be 75 basis point cuts to interest rates over the next 6 or 8 months. And if that happens, then that's a reflection of the fact we've got a softer economy. But don't worry about that. I mean, it's marginal. We're not talking about unemployment going from 5% to 15% or 20%. We're talking about marginal differences. And this is a business that's absolutely leading its space. And it will do well in 5 years' time, in 10 years' time. And in that time, unemployment will go up and unemployment will go down. I'm less worried about that.
Yeah. And even on a valuation point of view, it's trading on about 14 times, I think. And you look at car sales trading on 19 times or realestate.com in the 20s. I don't think the valuation looks stretched. Steve,
I should say we own it, and we also think it's cheap.
Yep, I own it personally, and our clients do. Steve, have you had a look at it?
Yeah, my clients own this one. From a technical perspective,
it's a sell. We all own it.
It's 3 from 3.
3 out of 3. It's got to go down now. Yeah, absolutely.
Okay, we'll move on from there. Bronwyn, I think, is the next caller from Queensland. Bronwyn, what can we help you with?
Hi, thank you for taking my call.
No worries.
Could I please have the panel's opinion on Eastland Medical Supplies? EMS is the code.
EMS, that's not one I've come across. Roger or Steve?
Neither. It's not coming up. I'm just looking at our portfolios.
Wow, look at it go there. It's from 1 cent to 3.5 cents. It's I don't know what the market cap is, but it looks like a pretty small company.
I'd be interested to know whether they're forecast to make a profit, because they haven't made one yet. So it'd be interesting to know that. In fact, Scaffold rates them a C3, which is not investment grade for us. So it sounds like their balance sheet's not very strong either. I can't tell you any more than that. Sorry, Bronwyn.
I think, again, Bronwyn, sometimes the same comments, with biotechs and resource stocks can apply. Directors can get itchy fingers after their shares have had such strong runs. They've got a corporate raising generally put away of a broker, and the broker says, we can't underwrite it for you now, but if the conditions improve and your stock does something, we might be able to get it away. And you can often find that suddenly the stock runs and then bang, capital raising, and it takes the steam out of it. So check the cash position.
There's something about a malaria, I just did read, there was something about a malaria vaccine gaining momentum, and that was back in August. So we're talking about a little while ago, but yeah, that's all I can see on it. But they're not making any money, so it is speculative.
Yeah. Okay. Don't put into it what you can't afford to lose, I think is probably the motto there. Okay, we might take an email now. We've got an email from Tim here. He said he'd be interested to know the panel's opinion of a property development company called Cedar Woods. CWP is the code. They have projects in WA and Victoria. They seem to be in pretty decent health with a decent return on equity and minimal debt. Do you see an opportunity here? Tim, I've had a look at this stock in the past. I've actually been tempted to buy it in the past. They are a developer as opposed to a passive property owner. The NTA, I think, is about $5.40 per share, and they're trading at a big discount to that. But however, under Australian accounting treatments, they do report a much lower NTA because a lot of their properties are land banks. But they have grown their earnings every year right through the GFC. They've grown their dividends every year through the GFC, and I think they're trading on a P of about 5.5 or 6 times. I know some pretty decent rated managers are on the share register. Have either one of you guys come across this one?
No, I'm sorry I haven't, but I'm just reading about this. I just want to go back to Eastland Medical Systems. Well, why not?
Okay.
You're the host of the show.
I am.
Can I do it?
I'm going to tell you not to, but you can. Go ahead.
It's interesting. There's a phase 3 malaria clinical trial at the moment for Eastland Medical Systems. And manufacturing of registration batches of their product in Canada is progressing on time and on budget. I'm just reading that straight off a report here. Malaria obviously kills millions of people around the world. This treatment is an under the tongue treatment which gets into the bloodstream and apparently has a much more effective result. If it works, obviously this business could be worth significantly more.
Definitely.
I suspect that's why their share price has gone up. Back to the property stock.
Yeah.
Sorry, can't help
Cedar
you.
Woods property.
Yeah, no, don't mind. Can I add one thing?
Yep.
Not specifically about Cedar Woods.
Yep.
We've previously invested in property trusts, and the ones that we like the most, in all seriousness, are industrial property.
Yep.
If you look historically at the management of property and the ownership of property, possibly the worst to own for a very long time is office space.
Yep.
And office buildings. All of your capex is in the building, and that building depreciates and stops being an A1 property or AAA property. It ends up becoming second grade or third grade even, and you've got to keep tipping money in.
Yep.
And the more floors you've got, the more you've got to spend on it. What I like about industrial is it's all in the land. All the value's in the land. You put a tin shed on it. And you can knock that shed over at any time and build another one, a bigger one or a smaller one, or divide it up any way you like. So I think if you want to sleep easy at night, notwithstanding the fact that all of these property trusts completely screwed over their unit holders after the GFC by issuing shares at a significant discount. So notwithstanding that, I think if you're going to sleep easy at night, then you really focus on the industrial space. I think that's a really safe place to be.
Yeah, I agree. Look, one I've been looking at in the really micro end is actually a company called Mirvac Industrial, MIX, which is actually in the US, in Chicago. So it does sound... Are
they owed any money by Nathan Tinkler?
I hope not,
no,
because I own some shares in them, so I don't want them to. Yeah,
the court ordered him to pay.
What's going on with Whitehaven? Nathan Tinkler, I think they're gunning for a margin call. A lot of these hedge funds are short selling the stock to try and trigger it.
I know some of the biggest short selling funds in the world.
Yep.
I suspect they're short this particular stock, and they have been for some time.
Yeah. Well, look, I'm not surprised by that, because if there was a stock I was going to short in the market, that would be it. Because I think at some stage he will need to sell some stock. And, what do? Do you sell 1 million or 2 million shares, then everyone thinks you're going to sell more and you're going to front run it. Anyway, I'm getting the wind up in the ear there, so we'll leave it at that. Thanks so much to our guests, Roger Montgomery and Stephen Hogan, and to you, the viewers, for all your calls and emails. It's what makes the show, so please keep calling in. Until next time, I'm Ben Clark.